In the world of investing, few things hold as much power as compound interest. With just a small initial investment, you can watch your money grow exponentially to multi-millions. But what if you have a good starting budget? What if you have $100,000 to invest? In today's video, I'll show you and John how and what you can get in return from $100,000, specifically when invested in the most famous Fidelity index funds. In the end, I'll show you a portfolio that has the potential to make you a multi-millionaire and also pay over $70,000 in dividends annually. Index funds are like big baskets of stocks or bonds that are designed to match the performance of a particular market index, such as the S&P 500 or NASDAQ for that matter. Just as a toolbox contains a range of implements from hammers to screwdrivers to wrenches, index funds hold a diversified portfolio of stocks or bonds representing different sectors and industries. They aim to mimic the ups and downs of the market they're tracking. Fidelity Investments is one company that offers these index funds. They're like a store where you can buy these baskets of stocks or bonds. Fidelity has a variety of index funds that cover different parts of the market. For example, they might have one fund that follows all the big companies in the United States, the Fidelity Large Cap Stock Fund, and another that focuses on smaller companies, the Fidelity Small Cap Index Fund. Likewise, some funds track bonds, finances, and technology. Now, why should you consider investing in index funds like those offered by Fidelity? Well, there are a few good reasons. First off, they offer diversification. Diversification in simple terms means not putting all your eggs in one basket. If the basket falls, all the eggs break. When you invest in an index fund, you're spreading your money across many different companies or bonds. So if one company does poorly, it doesn't hurt your overall investment too much. Another perk is that index funds usually have low fees. With index funds, these fees are typically lower because they're not actively managed by a team of people trying to pick the best stocks. Instead, they just follow the market index, which requires less work and therefore lower fees. Lastly, index funds are managed passively, meaning they don't try to beat the market. Instead, they aim to match its performance. This might sound less exciting, but in the long run, it can be a smart strategy. Many active managers struggle to consistently beat the market, so by going the passive route, you're setting yourself up for more predictable returns over time. The passive route might sound like a low return, but in the end, I'll show you how, even with a passive and relatively safer approach, you can still achieve a multi-million-dollar portfolio valuation that pays over $70,000 in annual dividends. So now that you know what index funds are, the next thing is allocating funds. You might wonder why we're talking about investing exactly $100,000. Well, it's not just a random number. $100,000 is a significant amount because it's a sizable chunk of money that can have a big impact on your financial future. Let's break it down. When you invest $100,000, you're starting with a good chunk of money that has the potential to grow over time. Even if you just earn a small percentage back each year, it can add up to a lot of money over the years. For example, if you invest $100,000 and earn 7% back each year, after 30 years, you could have over $310,000. That's more than 3 times what you started with. This return can be increased even more with compounding. It's like a snowball effect. Your money grows, and then the growth itself earns even more. So if you keep reinvesting your earnings each year, that $100,000 investment could grow to over $761,000 after 30 years. That's almost 8 times what you started with. So while $100,000 might seem like a lot of money, it's actually a smart investment amount that can set you on the path to financial success through the magic of compounding returns. Now that you understand why $100,000 matters, the next step is choosing the right investment option. However, there's also a slight step between the investment amount and choosing stocks, which many newcomers tend to miss, and that is determining your retirement goal. You can have all the money, but if you don't know what your goals are, you're just shooting in the dark. So before selecting which Fidelity index fund to choose, you need to have a set goal of what you want to achieve for your retirement. Do you want to live off dividends, or do you want to reach a specific valuation mark? In the end, I will show you how you can achieve both with a combined portfolio of Fidelity index funds. A portfolio that has the potential to make you a multimillionaire and also pay over $6,000 in dividends each month. But first, like we said, you have to set your investment goals. Before you start investing, you need to decide what you're saving for, like retiring early or buying a house. You should also think about how long you can leave your money invested, maybe 5 years, 10 years, or even 30. It's also important to know how comfortable you are with the possibility of losing money, because investing involves risks. To make investing safer, you can spread your money across different types of investments and markets. This is what we call diversification, and it helps lower your risk. Now, when it comes to selecting Fidelity index funds for your investment portfolio, it's crucial to consider the different types available and how they align with your financial goals, risk tolerance, and time horizon. For this video, John is considering a safe and balanced approach. He doesn't want to expose himself to too much risk, but also wants to have a reasonable portfolio value after 30 years that can cover his monthly expenses. So now I'm going to show you my top 5 picks for the $100,000 portfolio, Fidelity Index Portfolio. The first one is the Fidelity Freedom Index 2060 Fund Investor Class. This fund is designed for investors with a long-term horizon, such as those planning on retirement around the year 2060. It offers a diversified mix of stocks and bonds that automatically adjusts over time to become more conservative as the target date approaches. This fund is ideal for investors who want a hands-off approach to managing their portfolio and are comfortable with a higher level of risk in exchange for potential long-term growth. The second index fund for this portfolio will be the Fidelity 500 Index Fund. This fund tracks the performance of the S&P 500 index, which represents the 500 largest publicly traded companies in the United States. Investing in this fund provides exposure to a broad range of industries and sectors within the U.S. stock market. It's suitable for investors seeking steady growth and stability over the long term, as the S&P 500 has historically delivered solid returns. Then there's the Fidelity NASDAQ Composite Index Fund, which includes more than 2,500 stocks, primarily technology and growth-oriented companies. This fund offers exposure to the dynamic and innovative sectors of the economy, making it appealing to investors seeking higher growth potential. However, it's important to note that this fund may also experience higher volatility compared to broader market index funds. Also, we have to go green, right? And that's where the Fidelity U.S. Sustainability Index Fund comes in. For investors who prioritize environmental, social, and governance factors in their investment decisions, this fund offers exposure to companies that demonstrate strong sustainability practices. And finally, we have the Portfolio Booster, the Fidelity Multi-Asset Index Fund. This fund provides diversified exposure to a mix of stocks, bonds, and other asset classes, offering built-in diversification within a single fund. All these are good index funds, but they have different goals. For instance, the Fidelity Freedom Index Fund aims to help investors retire around 2060. The Fidelity 500 Index Fund provides exposure to a variety of U.S. companies. The NASDAQ Composite Index Fund focuses on offering exposure to technology and growth-oriented companies. The Fidelity U.S. Sustainability Index Fund focuses on sustainable companies. And the Fidelity Multi-Asset Index Fund offers diversified exposure across stocks, bonds, and other assets. Like we said, all of this is great, but for our portfolio, we want to have a good portion of each of these objectives. For this, you need to make a portfolio. From our above discussion, we should have a table like this for our portfolio. To find your portfolio's average current dividend, dividend growth, and average annual share price growth, you need to add all the numbers in the vertical column in their respective metrics and divide each sum by 5, which is the number of investments, stocks, or indexes we're holding. For our portfolio, we get a current dividend yield of 1.63%, a strong dividend growth rate of 11.27%, and an average portfolio appreciation of 8.35%. Together, these 5 Fidelity index funds create a well-rounded portfolio that balances growth potential with risk management. The combined metrics indicate a portfolio with moderate dividend yield and solid growth potential, aligning with long-term investment objectives. The big question now is, how much would John make if he invested $100,000 in this portfolio? Here's the breakdown of John's future projection with $100,000 in this Fidelity Index portfolio. After just 1 year, his investment grows to $109,982, marking a modest yet promising beginning. After 10 years, his investment is projected to more than double to $264,454, highlighting the steady accumulation. But the real magic of compounding shows up in the decades that come after. By the 20-year mark, his investment, thanks to compounding, is expected to be an impressive $739,750. At the 30-year milestone, John's investment of $100,000 is projected to be valued at an astounding $2,228,989. This portfolio will pay him $74,680 in annual dividends, or $6,223 each month. This fund will add around $2,128,989 to his bank, with total capital appreciation reaching $1,556,808, and total dividend reinvestment contributing $572,181. These are good returns considering they're index funds. However, you can increase your portfolio value to $6 million with ETFs. Watch our video on what if you invest $100,000 in SCHD to see how.